Welcome to the Property Elite podcast. I'll be your host, Jen Lehman, chartered surveyor and co-founder of Property Elite. Stay tuned each week for more on industry hot topics, market updates and new RICS guidance. In this week's podcast, I've put together an A to Z of investment terms. It'll be interesting listening for APC and AssocRICS candidates involved in valuation and investment management. So here's the A to Z. A stands for all risk yield, a growth implicit yield used in an investment valuation that reflects all the risks and rewards of the subject property. B is for beta, a measure of volatility or systematic risk used in the capital asset pricing model. C is for capital stack, defining the priority of rights to income and profits generated by an investment. It can include common equity, preferred equity, mezzanine debt, and senior debt. D is for debt service coverage ratio, a metric to analyse whether an investment generates sufficient cash flow for lending to be repaid. It's calculated by dividing the net annual operating income by the yearly debt payments. E is for equity multiple, a measure of total return on initial investment, i.e., how much will an investor has made from an investment. F is for full repairing, a type of lease where the tenant is responsible for repairing the property, meaning that this cost does not fall to the landlord. G is for gap analysis, used in investment management to compare current performance to expected or desired performance. H is for holding period, the length of time that an investment will be held for, an important consideration when valuing using a discounted cash flow. I is for internal rate of return, a measure of an investment's profitability over its lifetime. A higher IRR indicates a more profitable investment. J is for junior debt, debt that ranks lower priority than senior debt. In the event of default, it will be paid after senior debt is paid back, and for this reason it's typically riskier but also offers higher returns. K is for key performance indicator, used to measure and analyse investment performance and to benchmark investments against each other. L is for loan to cost, a ratio that compares the finance cost to the total cost of an investment or project, including the purchase price. It can be used to analyse whether an investment should be funded or not by a lender, and a higher loan to cost indicates a riskier investment. M is for mezzanine debt, a combination of debt and equity financing ranking behind senior debt, typically higher risk but also offers higher returns. N is for net initial yield. This is the initial yield at the start of the investment, including purchaser's costs. O is for open market rent review. When carrying out a valuation, you need to consider the basis of review and any reversion at this point. If a rent review is on the basis of open market rental value, then you'll need to look at comparables to assess the level of rent. Open market reviews can be both up or down, depending on the wording of the review clause, and other rent review bases include index-linked and fixed. P is for purchaser's cost, typically deducted at the end of an investment valuation to calculate market value and allow comparisons with other asset types. They typically include agents' fees, legal fees, stamp duty, land tax, and VAT. Q is for quarterly in advance. Valuations typically assume that rental income is received annually in arrears, despite in practice being paid quarterly in advance. Software such as Argus will analyse the nominal equivalent yield arrears basis and true equivalent yield advance basis. R is for risk, an essential component of analysing investments or carrying out investment valuations. Risk can relate to both the wider market and the specific subject property. S is for senior debt, debt that takes priority over unsecured or junior debt and must be repaid first if a company becomes insolvent. T is for the time value of money, an important concept as £1 in 1 year's time is worth less than £1 today. This produces the PV and YP formulae that you may be familiar with in investment valuations. U is for unsecured. This is debt that's not backed or secured by collateral. It's typically riskier and offers higher returns. Examples include personal loans or some business bonds. This is different from, say, a mortgage, which is secured on the property by a first charge. V is for value add, an investment strategy where properties are purchased that require action to increase capital value. This can include re-gearing leases, refurbishment, repurposing, change of use, or reletting void units. W is for weighted average unexpired lease term, or WALT, a metric used in valuation to assess the weighted average number of years remaining on leases across all properties in a portfolio. X, and maybe this is cheating a bit, is for extra. You can never know enough about investments and valuation, so keep up with gaining extra CPD on the subject. Y is for yield, and yield is simply the annual return on an investment expressed as a percentage. It can be calculated by dividing the rental income by the purchase price and multiplying this by 100. And finally, a Z for zoning, a method of valuation analysis whereby the front of a retail shop is worth more than a rear. You can check out a recent blog we've written and a podcast we've produced to find out more. Thanks for listening to the Property Elite podcast this week. Head to our website to check out our full blog, free and paid support resources and services, free consultation for every single RICS APC and AssocRICS candidate, and also ask us any questions you have via the website chat blog. See you next week.